Most people are going to lose everything for two main reasons. First of all, they're short-sighted, and second, they're extremely arrogant. In 1980s, people lost half of their retirement and their savings because they didn't understand the knowledge, the price action, the volume, and the interest behind the prices of gold and silver. In 1980s, silver exploded to around $50 per ounce. People were so excited. They were hoping for $100. They were piling in. No one actually did the research or due diligence. What happened was that the crash that followed was shocking. 50% crash, and it happened in just a couple of days. We're talking 3 to 4 days. And people were calmed down. People thought that, okay, this is healthy pullback, the market will recover, everyone needs silver, the same thing that you usually hear, even these days, Silver is the precious metals like gold, they're always gonna be a demand or use case. Some people bought the dip, others stayed on the sidelines. In the next couple of years, after this dip, the silver dropped over 90%. This is a number that will shock a lot of people and will hurt even more people, because lack of sufficient knowledge and understanding prevents you from making the right decision, reducing your risk, controlling your position size, not overexposing yourself, because everyone can make a stupid investment decision, but not everyone could put all the eggs in one basket and hopes for the best. In 2011, same thing happened. Big run up, again, towards the $50 mark. People hoping to break even, people who purchased $50 in 1980s. They waited over 20 years. They were looking at $50 price, they were hoping, they were dreaming one day to sell back at 50 so they can break even. But then, the price didn't reach $50. Guess what actually happened? The same crash appeared. The drop was even crazier. Why is that? Well, the same people who manipulated the first run-up, Wall Street of course, were the same people who manipulated the second run-up. The drop in prices made the silver so weak. It created such a slow and thin volume, which chased off a lot of not only long-term investors, it chased off a lot of day traders, swing traders, people who usually create the volume, right? And you probably were thinking, okay, something that happens twice, people will learn. They're not gonna fall into the same trap. But they didn't. Now, in 2026, we had the largest crash sell-off dip in silver on record in a single trading day. We had 40% dip. Something that historically happened throughout the period of 3 to 4 days. Now, remember, looking back, every time when there was a sell-off, when there was a pullback in silver, it was not just one pullback. The first pullback was followed by another sell-off, continuations of sell-offs, which in the first case, in 1980s, after the first 50% drop, in the next couple of years, the prices of silver dropped over 90%. You put 100K, you wait 5 years, you have $10,000. How about this? And again, the hopes remain the same. Silver $200, silver surpassed $100, yes, $120, recent all-time high. But the pullback reappeared again. In 1980s, silver hit $50. People were hoping for 400. Silver crashed and then crashed again. In 2011, silver reversed some of the losses. It made its own way towards 50. People were hoping for 50. Silver crashed and then crashed again. In 2026, silver was about $50. Solid trading consolidation, 53, 54, maybe some days, maybe 60. People are hoping for 100. silver hit 120, but silver crashed 40%. And we're yet to see or experience the second crash that always comes so far, right? If you look at the chart, there's a technical site which usually is created by the machines, by the alternative trading systems, right? Wall Street, majority of the trading is not happening on the actual New York Stock Exchange. Majority of the trading is not happening throughout the actual physical humans executing the orders. They're not placing the orders, they're not analyzing the orders, they're not actually making decisions on the daily basis. What this means? Well, when you remove the analytical side from the human standpoint on the markets, and you understand that the whole trading is happening based on numbers, algorithms, and probabilities, you do understand that people who are emotional, who do not have the sufficient math background or algorithmic trading data that supports the thesis on a daily basis for the prices, the volume, the interests, and of course, the probability scenarios, you lack competitive edge or advantage. And markets are super competitive, and they're not only competitive on the capital side. Most people still think that the people with the most money are the most competitive on the market. But there are many hedge funds and Wall Street firms who close doors. They file for bankruptcy. They had the money though. They were rich, they were having hundreds of millions, even billions of dollars under management. But they still lack the superiority of the trading strategies. They lack knowledge, probability games, they lack very good quantitative trading, they lack technology side of the trading. This is why trading is so competitive, and if you don't have either the knowledge, the skill set, or the actual systems in place, you are the target of Wall Street every single day. You're helping them to buy when they want to buy and to sell when they want to sell. Unfortunately, you cannot help yourself. You can only help yourself by preventing you losing money, which means spending more time working or crafting your own risk strategy that will prevent you from getting your account completely blow off.